Hello everyone and welcome to my channel. In this video we're going to talk about one of the most intriguing tech companies that has been trading on the Nasdaq, Nikola Motor. It has been one of the rising stars back in the 2020 era when the EV seemed to be on the verge of taking over the universe. Of course, that's not how things played out, and today most people are left wondering whether there is any possibility for Nikola to recover its former glories. In this video, we're going to talk about Nikola, the recent price actions, the technical aspects, and the best trading approach given the circumstances. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Over the past few days, Nikola has been trading around 90 cents level, which marks a 6% increase from where things were just a few days ago. The overall tendencies remain bearish as the stock fell to about 9% over the course of 1 month, and then decreased by 20% over the course of the previous 6 months. All things considered, while there's a myriad of reasons why the sell-off pressure was likely to be kept on for a foreseeable future, Nikola has been one of those companies whose reputation was pulled in the mud when its founder and former CEO Trevor Milton got accused and eventually convicted of lying to investors and committing fraud. For a company that should have been collapsing right now and then, Nikola has miraculously, had a very long lifespan and seems to have suffered even less than most other companies as the EV bubble eventually collapsed. Nikola has obviously been plagued by internal problems and external challenges, as the supply chain issues, the cash flows, and the remainder of trust in this company have all been lacking. What we know for sure as well is that Nikola is severely affected by the change of investment conditions, with a yield of capital being much higher than where it was just a few years ago, enticing a lot of capital to go back to safer and more predictable investment options than equities. Nikola is now a company that can be qualified as a penny stock, fighting to remain relevant and to be listed on a Nasdaq, and may have a lot of volatilities in the upcoming month. And this is why I believe that it may have a place for some portfolios. With that being said, here's a quick look at the technicals. The trading volume of Nikola Motors has recently been around 46 million shares, compared to the average volume of 132 million shares. Over the previous 52-week period, the price fluctuated between 52 cents and $3.71. The volume of shares traded tells us how many shares are being bought and sold at any given point in the market, and if there's enough liquidity to support a trading strategy. If the float is very thin, it would be very easy to influence the stock price around. The same low liquidity could also mean that the demand is limited as well. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference were very large. For instance, in case of breakthrough, the current volume would be significantly higher than the average volume. The market cap of Nikola is currently around $914 million. As we compare the current price to the historical price fluctuations, the stock is 34% higher than the 1-month low, 34% higher than the 3-month low, and 71% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 144%, compared to a historical volatility of 115%. The put-call volume ratio is currently around 115%. It is normal for most stocks to also tend to have a higher put option volume than what they truly deserve, as many long positions held by institutions are protected with put options. The most recent volume of options traded is around 75,000 contracts a day versus the 30-day average of 97,000. In terms of open interest, the most recent volume of open interest is around 1.6 million contracts versus the 30-day average of 1.8 million contracts. Regarding the shareholder structure, institutional shareholders hold about 24% of the current float, which is significant given the history of the company. The biggest shareholders include Vanguard, BlackRock, and Citigroup. Usually, it's always encouraging to see some institutional participation when holding a stock long term, and it goes double for something like Nikola. It offers a layer of stability and reliability despite the checkered history. It means that the market still believes that Nikola will deliver value in the long term, an important factor to consider for any investor. I personally consider that the minimum threshold should be around 25 to 30% for institutional ownership. There are, of course, many exceptions to this rule, as there will always be great companies mostly owned by retail traders. The current short interest is around 18% of the total float and 50% of the transactions from the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant portion of the short volume coming from the dark pools, it can suggest that there are institutional positions taken to short the stock, which can be the case at the moment, and which may argue for the potential for a. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. So, to conclude, I believe that Nikola is only worth buying if your portfolio has a very high risk appetite and tolerance for volatile, risky titles. The current market is good for an entry, but it's better to wait for more support before committing more capital. The short-term trading is more recommended compared to the long-term holding. So I would recommend to commit between 0.5 to 1% of your portfolio in Nikola overall, and to split the allocations in batches of 10 to 20% at a time over the next 3 to 6 months, so that you may purchase more in case it pulls back.